Silver just triggered a behavior shift most people never notice. Dealers aren't debating price anymore. They're locking supply. And when that happens, the move doesn't start. It accelerates. It was the kind of day that will be whispered about in commodity circles for years. Last Friday, silver experienced one of the most violent single-day swings in its century-long price history, crashing as much as 30+% after earlier parabolic gains. Prices that had flirted with record highs suddenly gave way to forced liquidations, dollar strength, and global risk repricing. What seemed like a rally destined for the textbooks turned into a market that in the space of hours proved just how fragile confidence has become. Yet beneath the carnage lies evidence of something far more powerful, a structural shift in how the silver market behaves, how participants respond to uncertainty, and how the metal's value is perceived across the globe. Let's pause for a quick moment. If you are getting value from this video, please take a moment to subscribe to this channel. It takes 2 seconds and helps the algorithm know you are interested in this content. In the sections that follow, I will guide you through 4 critical ideas that explain why this isn't just another volatile commodity move, and why this shift matters more than almost any catalyst in recent memory. To start, I will demonstrate exactly how the price action of late January changed the market's internal wiring. After that, I will help you understand the macroeconomic mechanisms reshaping supply, demand, and investor psychology. Then, I will unpack the structural forces, from industrial demand to global monetary pressures, that make silver's behavior today fundamentally different than it was just weeks ago. Finally, I will walk you through how this kind of pressure buildup sets the stage for explosive upside that can dwarf even the recent blow-off moves, and why you must grasp the timing if you intend to act. Stick with me until the end, because I'm going to show you exactly when to make your move into silver or head for the exit door. What happened around January 30th was staggering in its magnitude. After rallying to record territory, with COMEX futures trading above $120 per ounce, and broad market optimism driving speculative demand, silver was hit by a cascade of selling that left many market participants reeling. According to historical futures data, silver's price moved from mid-$114 range on January 29 to as low as roughly $74 on the 30th in intraday trade, representing a plunge exceeding 30% in the space of a single session. This wasn't just profit-taking, this was a structural break in the pattern that had guided traders' expectations. The previous month had seen silver up more than 165% year over year, with an all-time high area near $121.64, levels not seen in decades. Then, almost in a heartbeat, that strength gave way to one of the steepest percent declines on record. Behind those price candles was something deeper than trader panic. Dealers and market makers, who only weeks earlier were absorbing inventories and quoting tight spreads, suddenly faced a liquidity crisis. Extreme implied volatility and margin calls forced institutions to reduce exposure, widen bid-ask spreads, and temporarily withdraw from providing depth in the market. Suddenly, the uncertainty that had been a faint hum grew into a deafening roar. When market participants begin to hoard inventory rather than trade it, you know behavior has crossed a threshold. Logic gives way to instinct, and reaction times shorten. This change in behavior is tied to the broader macroeconomic landscape. In the weeks leading up to the crash, global financial bears and bulls were locked in a tug-of-war of historic intensity. Inflation fears, geopolitical tension, and expectations for U.S. monetary policy had sent a shockwave through commodity markets. Silver's industrial use in photovoltaics, electronics, medical equipment, and defense tech remained structurally robust, even as speculative fervor drove prices skyward. That dual purpose of silver as both a hard industrial input and a store of value put it in a rare cross-current. Investors won't abandon industrial metals that underpin massive sectors of the global economy. Yet they will also flock to perceived hedges against macro risk. But what truly transformed the market was how traders and dealers responded to the shock of January 30th. They didn't simply sell out of fear. They recalibrated risk models, widened liquidity buffers, and mentally retagged silver as a market with a new baseline of volatility and structural fragility. The days of calm retracements before continuation moves gave way to extended range breakouts and then violent whipsaws. This isn't noise, it's a regime shift. To understand why this matters, consider the feedback loops at work. As silver prices surged earlier in the month, long positions ballooned, hedge funds crowded into the trade, and futures volumes exploded. Such crowded positioning amplifies moves both up and down. When the price rises steadily, more leveraged money flows in. When it breaks, forced liquidations accelerate the decline. That's not conjecture. It is observable in the sharp volume spikes and widening intraday ranges, confirmed by futures data. But beyond purely technical mechanics lies a macroeconomic reality that few want to acknowledge. Silver is being priced not merely as a commodity, but as a hedge against systemic risk. In a world where central banks have pushed policy to extremes for years, investors increasingly look for assets outside of traditional financial data. The plunge on January 30th came largely in response to changing expectations about the U.S. Federal Reserve's path. Hawkish signals that strengthen the dollar and reduce the near-term attractiveness of non-yielding assets like precious metals. Yet that same dollar strength compresses confidence in fiat over the long horizon, which ironically keeps silver's strategic value elevated. Now layer on top of this the supply-side dynamics. Unlike gold, which has a large investment market and deep liquidity, silver's market is smaller and more sensitive to inventory shifts. When dealers start holding supply instead of trading it, bid capacity shrinks, premiums widen, and price discovery gets noisier. That's exactly what we've observed: bid-ask spreads expanding, physical premiums rising, and inventory at major exchanges thinning. These are not subtle shifts. They are structural reallocations of risk, and they reflect a market grappling with uncertainty rather than complacency. The interplay between fundamental demand and speculative positioning is another factor that separates this phase of silver's evolution from previous bull cycles. For example, industrial demand forecasts remain strong, particularly in sectors like renewable energy, where silver is an essential component of photovoltaic cells. This structural demand growth is persistent and growing, and it contrasts sharply with the short-term speculative spikes that characterized earlier price moves. In other words, there is real, everyday economic demand underpinning silver's value even as financial markets react to macro swings. This dual demand, both real economy and financial speculation, sets the stage for higher nominal prices over time. All of these forces suggest that silver's structural transformation is far from over. The record highs and violent sell-offs aren't anomalies. They are indications of an asset squeezed between two worlds, one driven by industrial fundamentals and the other driven by macro risk repricing. When such cross-currents exist, prices don't revert quickly. They melt up nested within volatility. Now let's get practical. The question everyone asks: when should you make your move? The answer lies in applying disciplined strategies that successful silver investors use to navigate exactly these kinds of environments. A. Don't fixate on the spot price alone. Accumulate incrementally using cost averaging to minimize emotional timing risk. B. Monitor the gold-silver ratio as a relative value indicator that often signals sentiment shifts before absolute price moves occur. C. Prioritize low-cost, physically settled silver exposures over high-premium numismatics to ensure capital is deployed efficiently. These aren't theoretical ideas. They're pragmatic frameworks that reconcile volatility with opportunity. The surge to record territory, followed by violent correction, reveals a market that cannot be timed with precision. Instead, disciplined allocation, combined with structural awareness, is what separates investors who benefit from those who merely react. In summary, what took place on January 30th, 2026 is not merely a freak sell-off or a one-off correction. It is evidence of a market whose internal wiring has been fundamentally rewired. Dealers locking supply rather than debating price means liquidity dynamics are different. Macro expectations around interest rates and currency strength are different. Structural demand from industry and technology is different. And the psychology of market participants, both speculators and end users, is different. This is why silver's next move has the potential to eclipse what we've already seen. History tells us that once behavior flips and traders begin to act on structural narratives rather than short-term price signals, price discovery becomes less anchored to conventional volatility. Instead, it accelerates into regimes of persistent directional motion. In markets, as in physics, once the switch is flipped, there's no turning back. Silver just flipped that switch. And if history is any teacher, the accelerations that follow such regime changes can become furious and far more prolonged than most expect. Prices well above conventional milestones like $100 per ounce become less about speculative aspiration and more about structural inevitability. The shift that January 30th revealed isn't normal, and that's exactly why it matters.